Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today you're here with Namek Zu'bi of Silicon Badia. Namek, thank you for joining us.
Thank you for having me, Hal. I'm very excited to speak and answer some questions.
Sure. So let's start off with, what was your background before investing in early stage companies?
Sure. I'll start with some of my personal background. So I'm born and raised in a small country called Jordan in the Middle East. And I've always been fascinated with technology. You know, the Middle East has been a little bit behind with tech over the last 10, 20 years. So I decided to come to the US for a university, and I majored in computer science. And that's kind of how I fell into this general tech landscape. Went to a school called Carnegie Mellon in Pittsburgh, and then eventually found myself in financial services. So I wanted to work within a big bank and see how they use tech to solve some of their problems, including trading technologies. So I worked at Deutsche Bank at a very interesting time, 2008, and kind of worked on enterprise B2B applications within the bank. And then I was lucky because I got a phone call from a professor of mine from Carnegie Mellon who was involved in the startup landscape and said, "Hey, I know you've always been interested in startups and investing, and you have your family's a family of entrepreneurs. There's a guy that's trying to start a venture capital fund in New York, and he doesn't know much about tech. Are you open to meeting him?" So I met him, and we launched a fund called Clove Hitch Partners in 2009. When I say we launched, I mean he launched and I joined as his first hire, and that's how I got into the space. It's an unorthodox way of getting in, but I found myself in it. I was thrown in the fire, and I've been running since. After I left and started my own fund a few years after joining his.
Well, great. Well, it sounds like you've had a good ride there and have seen quite a bit from 2008 to now. Has been quite a bit of history. So for all of the investors that listen, what's your advice for them about investing in startups in the early stage? What would you tell them to do before they start writing that check?
Yeah, I think this industry has become sexy over the last 10 years. And when I mean sexy, I remember 2008, 2009, specifically in New York, I was an outcast when I look at my own social circles in terms of investing or working within this industry. Today, it's the complete opposite. Everyone's trying to work within the space or even invest, whether as an angel or trying to get into a fund. First thing I'd say is 9 out of 10 companies fail. So if you're going to start investing, make sure you build a diverse portfolio, right? If you're only going to put money into 1 or 2 companies, then the likelihood is you're going to lose all that money. But if you put money into 10, 15, 20 companies, and a few of those are winners, then you'll make money and cover some of the losses you'll have. So 1 is diversification. 2 is patience. This is a get rich slow space for the most part. A lot of people get caught up in the news and media, which cover some of the outliers. But for the most part, it's a slow industry. So you have to be patient. You have to go through the motions. And the third kind of piece of advice is figure out what your sweet spot is. If you're a banker, a doctor, a consultant, a doc, someone that works in the medical space, someone that comes from a farming family, see whether you can leverage your background, your resources, your knowledge, and make investments in industries versus trying to really go off the deep end and invest in all sorts of things. So those are kind of my 3 overall pieces of advice.
Well, that's good advice, and we should take that to heart. So you've been around for some time now and seen venture go through many cycles. Where do you think the state of investing in venture is today? How is the industry evolving?
Yeah, a few trends here. 1, it's global. So 20 plus years ago, Silicon Valley dominated the global news. Today, it's all over. Even our fund also invests in the Middle East, North Africa. So we're seeing a lot of activity even in small countries in those regions. So one, it's going global. Two, even in the US, there's what we call the rise of the rest. So about a third of our portfolio companies in the US are New York based, a third are Silicon Valley, Bay Area, and a third are the rest of the US, Austin, Kansas City, Tennessee. And we're seeing that portion grow bigger and bigger. So I think what's interesting to us is what's happening outside of the historical main cities of tech and venture. Three, we're seeing more and more people choose this to be their career path. Again, I refer to kind of when I graduated in 2007, 2008, I was a rarity in my graduating class in terms of wanting to play in the space. Today, the majority of people want to. So you're seeing a resource and labor pool that's coming into this industry, which is allowing people to hire talent faster and grow quicker. A fourth trend is frothiness. And we can see that with some of the recent public market action for companies like Uber, Lyft, etc. So I think given the availability of money and over the last 10 years, a lot of people were chasing growth and sacrificing unit economics. And I think that's unhealthy. And we're going to start seeing kind of people go back to building a sustainable business versus trying to build a business quickly and take it public, make money, and then see the business kind of go down in shambles. A couple of other trends. One is what I call the SoftBank experiment. And this is related to the previous trend I just spoke about. You have people like SoftBank that are throwing hundreds of millions of dollars to companies and trying to create huge businesses. What happens with that? I think SoftBank is still an experiment. At least some of the Vision Fund and some of the stuff they're doing over the last 3-4 years. So curious to see where that ends. And finally, I think we're starting to see a gap in smaller seeds or pre-seeds. I think everyone moved up market. When I started investing, your average seed round was a $750K round. Today, it's $2 to $3 million, if not higher. We're seeing a gap in the people that only need $500,000 to $750K to get to that next milestone. And we're going to take advantage of that with our next fund in the US.
Well, that's good advice. I certainly agree. I think the market seems rather frothy right now. A lot of money is chasing fewer deals. And then the deals are now raising a lot more money than they used to. So they're trying to get big earlier than they normally did. So it'd be interesting to see how those trends play out over time. I do wonder if they're sustainable, but we'll see as time tells. But let's talk about your investment fund itself. What is your fund focus on, and what's your investment thesis for it?
Sure. So we launched our first fund in the US in 2012 under Silicon Badia. And it's myself and two of my partners that launched the fund, and we have a team of about 10 people scattered around the world. Our thesis in the US has always been pre-seed, seed, Series A companies that are in niche, inefficient, offline industries. So we've always liked things like fintech, health tech, real estate tech, ag tech, that's agriculture, waste management, anything that's kind of off the beaten path. A lot of investors, at least when we started, were neglecting because they weren't sexy. We like those types of businesses. Most of them happen to be B2B enterprise. Few of them are direct to consumer. We've made about 52 investments. We're closing our 53rd and 54th this week since 2012. And that's out of 2 funds. We're raising our 3rd fund. Knock on wood, both of our first funds are our top quartile funds from a on paper and distribution perspective. In parallel, and I don't want to focus too much on our second business on this call, but being originally from Jordan and myself and my 2 partners, we saw an opportunity to take advantage of a greenfield, much younger ecosystem, which is the Middle East ecosystem. So in 2014, we launched our first MENA fund. MENA stands for Middle East, North Africa. Over there, we're investing Series A, Series B, a little bit more broader from a thesis perspective since it's so young. But we see an opportunity to be a first mover in an interesting market if politicians behave over the next few years.
That's great. So, do you have a couple of portfolios that you think are good examples of the kind of businesses you fund? One or two would be very interesting to hear about.
Sure. I'll give you an example of kind of our last two deals. One is a company called Camber, and it's a group of entrepreneurs that have been working in the commercial aviation space, helping airlines figure out revenue management. From that experience, they saw how archaic, how old the systems most of the airlines around the world use to manage their revenue, what we call as revenue management systems, right? And so they launched Camber to take advantage of that and build kind of a new age revenue management system, starting with commercial aviation and then moving to other things like car rentals and other travel or transport businesses. Just close to $4 million seed round. We're leading with two other institutions. A second example is a company called Headnote, which is in the legal tech space, if we can call it that. So today, the top 50 legal firms or law firms in the world are owed $7 billion in receivables. People just don't pay them on time. And it's not because they can't or don't want to. It's because these account receivable processes within these law firms is just completely offline, inefficient, and archaic. So Headnote's trying to take advantage of that, bring the payment and billing processes online and help law firms kind of collect cash faster. So those are kind of good examples of the types of companies we like. They're going after old, archaic, offline industries and mostly B2B enterprise.
Well, that sounds great. Sounds like you have two very good companies there. But in general, when you look at startups today, what do you think are the major challenges they face in getting their business up and running and growing? Is it the regulatory that we're in? Are they technical challenges or are they more market challenges?
I'll talk about the startup challenges and then I'll talk about the investor challenges, since you mentioned there are a few investors in your audience. From a startup perspective, and this is having worked with over 100 companies in the last 10 years, it's people, okay? Very few cases is it regulatory, and it's when you're talking about things like fintech or health tech, then yes, I think regulation in many cases can cause issues. But for the most part, the one consistent challenge we've seen across our companies when they're trying to scale, which is the name of our game and venture, right? That's how we make money, is people. Managing people, managing culture, hiring, recruiting the right folks, firing fast when you need to, and building a real organization across every level that's a well-oiled machine. A lot of our companies that have failed or are doing poorly are unable to do that. And the ones that do, the founders become redundant. The best sign for us, for a company that's doing well, is when a company reaches a Series B or C kind of level, and the founders are redundant and are just sitting there and saying, I need more work because I've hired so many smart people around me. The machine's just moving swiftly. Does that answer your question on the challenges for startup?
It is. And I hear it often. Finding talent is part of it, and then organizing the talent in a growing company is another issue that comes up. And you brought up some other good points there as well.
Absolutely. There's a lot of noise, and you see this all over the last few years for various reasons, whether it's more people coming into the space, whether it's media, whether it's platforms like AngelList or other crowdfunding platforms that are giving people access to deals. There's a lot of noise. So we have to work harder as investors to kind of pick the winners from that, which is why I mentioned at the beginning, diversification is key, because you only know what you know in the early stages. So it's valuations. We've been seeing, we just passed on 2 deals last week because pre-revenue company raising a convertible note, an uncapped convertible note, or a pre-revenue company with one person raising a equity round at a $15 million pre-money valuation. It's a little bit crazy. So valuations, I think right now are unrealistic, which is why, going back to one of the first things I mentioned, we like cities outside of the main tech hubs. We're finding really good companies in Utah and Kansas City, in Austin, or Texas in general, I should say, Florida. and valuations are a little bit more saner there. The third, and this is not a challenge as being an investor, but a challenge we're seeing in the space, is diversity, whether it's on the founder or startup front or on the investor front, getting more women, more underrepresented folks, which I'm included in that bucket, being an immigrant in the US, getting more of those people involved. What's an interesting trend I'm seeing, I just got a term sheet, we're looking at a deal. Investors are starting to include diversity clauses within their term sheets. Obviously, they're non-binding, but at least they're putting it people's and founders' minds that, hey, we want you to really be aware of who you're hiring and make sure you're hiring a diverse workforce.
Well, certainly diversity is coming to the fore, and it's great to see people actually putting that in writing in various ways. Like you say, it can be hard to make that binding, but it starts to show the importance of it, and I think that's a good step in the right direction. You see a lot of different startups in different areas out there. If you had to pick 2 or 3 sectors or applications that you think are good immediate opportunities to pursue, what would you call out as the low-hanging fruit, so to speak?
I think a few things. One, as I mentioned, we like pre-seed. I think if an investor is willing to actually think versus just follow others into a big round, the crowd effect, I think you can make good investments at reasonable prices early on. So we see a gap in pre-seed. We still see a gap in kind of the niche, non-sexy sectors that we like. Investors, you have to understand, for the most part, in early stage, people are investing because they want to make money, but they're also investing because they want to tell their friends a story over dinner, which is why telling someone you invested in the waste management company over dinner doesn't usually sound that sexy. So we still think people that are focusing on some of these kind of offline industries, there's still a long ways to go there. As I mentioned before, we like the rise of the rest. We like companies out of the big tech hubs. Obviously, and your listeners have heard this a million times before, but artificial intelligence and blockchain are still at their infancy. So we're excited to see kind of what happens over the next few years within those sectors and see AI and blockchain, get applied to a broader kind of set of applications versus the ones that are in today. Last but not least, health tech and insurtech. These are some of the most challenging sectors to invest in because of regulatory risk and, long sales cycles and what have you. But they're still super messed up. And there's a lot of opportunity there if you find someone that's doing the right thing. So we like those 2 sectors.
Well, that's great. Those are good target opportunities for sure. In the last few minutes that we have here, what else should we cover that we haven't?
I think we've done a pretty good job. Just one parting message is specifically to people that are investing or thinking of becoming investors. Don't get emotionally attached. Try not to get emotionally attached to your portfolio companies. I know it's hard to say that, easier said than done, but this industry is full of failure. So just because 1 or 2 of your portfolio companies went under, learn from those mistakes. The best thing an investor has is pattern recognition intersects with gut. And gut is built over time. And the only way it's built is if you get knocked around a few times, right? So don't be afraid of that. Learn from those experiences and build a better process for your next investments.
Yeah, you always learn more from your failures than from your successes. So they have that value. Well, great. Well, how best for listeners to get back in touch with you?
I think we have our general kind of info at siliconbadia.com, which you can find on our website if you just go to www.siliconbadia.com. That's the best way to get in touch. The ultimate best way is through a warm referral, right? If you know someone that knows us, that's the best way to get in touch. LinkedIn, sure, you can add me on it, but I get 30 to 40 messages a day, so that becomes a little bit of a problem.
Well, great. We'll put those in the show notes and hope to have you back for a follow-up soon, and want to thank you for your time.
Thank you very much. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.